What's happening, Denver? I'm Tom Sagona, and I'm very excited to bring you up to speed because November's reports seem to indicate that several major turning points may be coming in the real estate market very soon. In fact, there's so much to cover, I've decided to split this month's update into 3 parts. Part 1 will talk about what's going on with interest rates. Part 2 will tell you all about housing prices. And Part 3 will focus on timing your purchase or sale to maximize your benefit in the coming months. So, let's talk about what's going on with interest rates today, what it means for the real estate market as a whole, how it applies to the greater Denver area, and, most importantly, how you can take advantage. On October 24th, the Federal Housing Finance Agency officially approved new changes to the way your credit score is calculated when you apply for a conventional mortgage. If you're concerned about how this will affect you, it would be a good idea to review the changes in detail. But generally speaking, if your score is already high, reports say it's likely to go higher, and if your score is already low, reports say it's likely to go lower. Fortunately, the change will take time and will be a multi-year effort, so you have plenty of time to prepare. Just keep this in mind if you're planning something a year or two down the road. However, the new system will also make it possible to score approximately 12 million credit-worthy consumers who previously had no score at all. So, millions of Americans who were previously ineligible to apply for a mortgage may be about to join the fun. Meanwhile, on November 2nd, the Federal Open Market Committee raised the target range for the federal funds rate another 75 basis points, which puts the new target range at 3.75 to 4% and marks the 4th 0.75% increase in as many months. Now, the funds rate affects the economy in a lot of ways and doesn't directly dictate consumer interest rates. But it is a major influencing factor, so it's no coincidence that rates have been going up at a similar pace. November's funds rate hike didn't cause mortgage rates to rise significantly, though, probably because it was expected and had already been priced into the market. What economists didn't see coming was the October CPI report, which came out on November 10th. The Consumer Price Index essentially measures the average cost of all the basic goods and services people require, and is widely accepted as an indicator of inflation. And when you look at what's been going on with the index lately, it's easy to see why the current situation is pretty alarming. The only problem with this graph is that the index typically only changes by a fraction of a percentage point from one report to the next. So rather than looking at the index itself, it's much easier to track inflation by looking at the percent change in the index year over year. Now, the CPI tracks a lot of things, but these 2 lines right here are the most important. This line shows the percent change in the headline CPI, which factors in all categories. And this one shows the percent change in the core CPI, which includes all categories except energy and food. It's generally good to look at both because food and energy tend to go up and down a lot more. So while swings in the cost of food and energy can have a significant effect on the overall average, they may not always mean there's something wrong with the economy as a whole. And that's another reason why what's happening right now is so concerning. Because you can see it's not just food and energy that are going up way too quickly. It's everything. In October's report, however, the headline Consumer Price Index, which was up year over year by 8.2% in September and was expected to be up by 7.9% year over year in October, came in lower than predicted at 7.7%. Not only that, but the core CPI showed a reversal from the increases we were seeing the 2 months prior, dropping down to a 6.3% gain year over year. Now, these changes may seem small, but after so many months of disappointment and despair, the world was ready to welcome any indication that real sustainable gains against inflation may finally be starting to show. So in response, the stock market, which was barely up from a 2-year low in October, saw its biggest single-day rally since 2020. And mortgage interest rates across the board dropped by roughly half a point, the largest single-day drop on record. And confidence seems to be holding because Friday's report from Freddie Mac shows that 30-year and 15-year fixed mortgage rates are continuing to come down. However, it's important to keep in mind that the gains we're seeing against inflation now are still very small. After all, inflation has been out of control for more than a year now, so at this point we're doubling down on last year's increase, and in the last 4 months combined, we've seen a total of a 0.8% improvement. So 7.7% is still a long way off from the ultimate goal of around 2%. And the Fannie Mae housing forecast on November 21st was a sobering reminder of that fact, predicting that 30-year fixed mortgage rates will likely continue to average around 7% for the next several months and stay above 6% for the better part of the next 2 years. So what does all of this mean for you? Well, as far as your credit score is concerned, the advice seems to be pretty much the same as it's always been. Pay your bills on time, don't rack up too much credit card debt, etc. However, it looks as though delinquencies and debt may be judged more harshly than before, and FICO 10T will now be looking at trended data over the last 24 months. So prepare to have your credit habits scrutinized a lot more closely. To be honest, tracking your credit score is probably something you should be doing anyway if you're planning to purchase a home anytime in the next couple of years. And there are plenty of free apps out there that will help you track your credit score and give you suggestions on how to improve it. That said, if your score is looking good, it might be worth looking into a 10-6 or 7-6 adjustable rate mortgage, because recently, average rates for 7 and 10-year ARMs have been considerably lower than 30-year fixed mortgage rates overall. Right now, it seems like a pretty safe bet that mortgage interest rates will drop low enough to justify a refinance at some point in the next 7 to 10 years. So even if you go with a fixed rate right now, you'd probably end up refinancing anyway. In fact, your lender may even include a free refinance as part of the loan package, so it's at least worth looking into as an option. Just be sure to do your own research as always and know what you're getting into, because an adjustable rate mortgage does come with its own set of risks, and interest rates could change at any time. Speaking of which, the reaction to October's CPI report certainly demonstrates that inflation is being closely watched and plays a major role in determining interest rates. However, one good report could be just a fluke, so at this point a lot of things hinge on the next report, which is due on December 13th. The Federal Open Market Committee is scheduled to convene the very next day to decide the next rate hike and will make their decision known on December 15th. So all eyes are currently focused on those two dates because the results will have a major impact on where we go from here. If the next CPI report does show further improvement, the Fed will likely begin to scale down the rate hikes. This currently seems to be the most likely scenario, with a 77% chance of a 0.5% funds rate hike on December 15th. However, there's always the possibility that December's CPI report could disappoint. And if that happens, the Fed would have no choice but to clamp down harder, raising the funds rate more aggressively and causing interest rates to climb even higher. At this point, all we can do is wait and see. So if you're in the market right now, it might be worth considering a 60 or 90-day interest rate lock with a float down option. As we've discussed, rates have recently dropped, and locking would protect you from higher rates if December's report doesn't go as planned, while the float down option would still allow you to take advantage if rates do go down. Your lender can tell you more about exactly how that works. But once again, there are pros and cons. So make sure to do your own research and decide what's best for you. That aside, regardless of what happens in December, there's still a long way to go when it comes to inflation. And as we've seen in my previous videos, Fannie Mae's last several forecasts have repeatedly proven overly optimistic. So personally, I would err on the side of assuming that this is the best case scenario, and while I'd love to be wrong, I think it's still a little early to be getting your hopes up for average 30-year fixed mortgage rates to drop much below 6% anytime soon. As for inflation, it's certainly great to see a sign that we may finally be making some real progress. Just don't get too excited because it's still pretty early to know for sure. And remember, we're talking about reductions in how much the cost of things is increasing year over year. So the gains we're seeing don't mean things are getting less expensive. They just mean things are getting more expensive slightly less quickly. And unfortunately, in the long term, that same principle may end up holding true for real estate as well. Because the latest reports seem to indicate that a major shift in real estate values may be coming a lot sooner than you think. So make sure to subscribe and hit the bell icon for notifications. And if you haven't hit the like button already, I really appreciate that as well. Thanks for watching. I'll see you again in part 2.